Welcome to this short and crisp webinar. You are going to get crystal clear clarity in this very short duration, and that's my assurance. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA nrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career in banking industry through State Bank of India, joined as credit analyst, in short period elevated as team leader, credit processing, had opportunity to work on 250 plus projects, it's 5,000 crore plus size. After 4 years of stint in State Bank of India, I moved to CA practice, had my practice for 7.5 years, parallelly took teaching assignments, started teaching financial management, strategic financial management for CA, CMA and CA students. I'm also an empaneled trainer with leading private sector bank for training their executives on financial analysis, working capital and project finance. Thanks to technology, today I teach 2 lakh plus students all over the world through my structured online courses, and it's because of the same technology you are also attending this mini webinar now. One more thing, if you don't have your notepad and pen, please pause the screen, go and take notepad and pen because you are going to have many key points to make note of in this session. Let's get into the presentation. Let's move on to very critical set of ratios, that is market value ratios, especially from stock market point of view. So in market value ratios, what we do is we basically compare the earnings in book value with market value. So there is going to be a comparison between earnings in book value and market value. So in these ratios, probably we have 3 or 4 sub classifications. Number 1, we have earnings yield ratio. Number 2, price earnings ratio. Number 3, price to cash flow ratio, and number 4, market value to book value ratio. So in this session, we'll be understanding each and every ratio. To start with, let's pick up this earnings yield ratio. Okay, so in earnings yield ratio, what we do, we are going to compare the earnings with market price. Okay, we'll be comparing the earnings per share with market price per share. Let's see, in earnings yield ratio, we'll be comparing the earnings per share with market price per share, and if I make it as a formula, it is earnings yield ratio is nothing but earnings per share divided by market price per share, and this can be expressed in percentage. Okay, so that's about earnings yield ratio. It's simple, but the next ratio is very critical, especially from stock market point of view, that is price earnings ratio. Now this price earnings ratio is nothing but inverse of earnings yield ratio. In earnings yield ratio, what we do is we take earnings per share, we divide it by market price per share. Okay, so in price earning ratio, what we'll do, we'll take the market price and we'll divide it by earnings per share. We take market price per share, we'll divide it by earnings per share, and what it gives is the number of times people are ready to pay for a share against its earnings. Okay, let's see. In price earnings ratio, what we do, we take market price per share, we will compare it with earnings per share. So if I put it as a formula, or what it basically conveys is multiples. That is one critical point is, I mean, when you compare this market price per share with earnings per share, what you get is a number which is the times or multiples, and that will give us a hint whether to buy or not to buy the share. Okay, so the formula part will say price earnings ratio, or very well known in the market, PE ratio. There's nothing but market price per share divided by earnings per share. As I told you, it is nothing but the inverse of earnings yield ratio. So market price goes to the numerator and EPS goes to the denominator. Now what is the implication of this PE ratio? Now let's say my earnings per share is 10 and market price per share is 100. So if I calculate the PE ratio, what happens here? If I calculate the PE ratio, what I get is market price per share divided by earnings per share, that is 100 divided by 10. I get PE ratio as 10 times of earnings. It means in market, this particular share is sold at a price which is 10 times of earnings. Now a question will arise to every investor, why this particular share is sold at a price which is 10 times of its earnings. There may be 2 reasons. Let's see. Reason number 1 can be high expectation. I mean, the shareholders are expecting this particular share to perform very well, not immediately, but in the future, say near future or in the distant future. So it is expected to perform very well, and it would improve the wealth of the shareholders. So that can be one reason. Then the another reason why it is sold at 10 times of profit, or why the PE ratio is 10 times, maybe because earnings per share is very low. Because look at here, the earnings per share is low, whereas market price is high. So because PE ratio is very high, now we have to understand why this EPS is very low. Now, is it because it is in the initial stages of its operation? In that case, yes, low EPS is agreeable, but if EPS has come down from the very high level, then higher PE ratio is not something which is acceptable. So understand, if a company is in its initial phase, obviously their EPS will be very less, but their market price may be high on account of high expectation. But vice versa, some companies would have been doing very well, and on account of which market price will be very high. And if for some or the other reason, if their earnings level has come down, and if the market price is still maintained at the same level, EPS would still remain low. Okay, EPS would come down to a lower level. So higher market price, lower EPS, PE ratio will be very high. So at that time, we have to appreciate that the higher PE ratio here is not on account of high expectation. It is rather on account of low profit. So this appreciation is required when PE ratio is analyzed. Moving on. So high PE ratio can be a result of high expectations, or it can also be a result of low profit. So we have to compare. Now, how do we compare? By looking at the PE ratio of a particular company, we should also look at the industry average. What is the industry average PE ratio? Is it comparable? Is it very high? Is it very low? That should be understood. Then we should also compare it with the other shares. Not only the industry average, compare with peers, how they are performing. Okay. So all these aspects have to be taken care, because high expectations is fine, but we should not get into the trap of the companies which are in the falling EPS zone. Okay, moving on. The next ratio is price to cash flow ratio. Now, the last two ratios where we have taken earnings yield and price earnings ratio, the focus was on the market price, right? Focus was on earnings per share. So earnings per share is something which is influenced by accounting policies, and it is also influenced by items which does not have cash outflow or inflow. So to overcome that, we had something called as cash flow earnings per share in our earlier session. Now that is brought here also. That is, we are going to consider the market price, but that is now compared with the cash flow ratio rather than earnings. It means we will try to find out the cash profit rather than earnings per share. Let's see how it goes. Here we will be comparing the market price per share with cash flow earnings per share. We know how to find out the cash flow earnings per share. It was profit after tax minus preference dividend plus depreciation, amortization, then plus or minus non-cash items. Let's see. So in price to cash flow ratio, the formula is market price per share divided by cash flow earnings per share, and we know what is cash flow earnings per share. Okay. Next, the final one, market value to book value ratio. In market value to book value ratio, we basically compare the market value and book value. For example, a book value of a share may be only 100 rupees, but the market value may be 500 rupees. Now, why market is ready to pay so much? And something similar to that is what we analyzed in PE ratio. But in PE ratio, the focus is only on earnings. We have seen how many times of earnings the market is ready to pay. Whereas here, we are going to see how many times of book value the market is ready to pay. And why the market should pay 500 when the book value is only 100. Maybe again the high expectations in the future, number one. Or number two, market understands there are a lot of hidden reserves. Okay, say for example, a company has lot of fixed assets, and most of its fixed assets are like land followed by building. Now land would have been accounted in their balance sheet at their historical cost. Say for example, lands which were purchased some 20 years, 30 years back. Okay, so they would have been purchased, say something like 30,000 rupees or 50,000 rupees or say 200,000 rupees, something it goes. Okay, but if you take the market value of those landed properties, it may be running in millions or it may be running in crores. But that real value may not be visible in the balance sheet. But the market understands that this particular entity has got so much of assets and its real market value is very high, but it is not revealed in the books of accounts because of the accounting constraints, accounting policy issues, because our accounting policy says if you are carrying a fixed asset, show it in historical cost, do not bring it to market value, and even if you bring it to market value, you have to create a revaluation reserve, and revaluation reserve is knocked off from the tangible net worth. Okay, so because of all this, market understands that this organization has got a hidden reserve, and so the market is ready to pay more, or the other side, market believes that they have lot of capacity, they'll be able to bring or add more wealth to the shareholders, so they are ready to pay more now itself. Okay, so let's see how it goes. In market value to book value ratio, we'll be comparing the book value of the share with the market value of share. So we should know what is book value of share. Book value of share is nothing but equity share capital plus reserves and surplus minus accumulated losses. So all put together will be called as book value, and if that is divided by number of equity shares, what we get is book value per share. Now this book value per share will be compared with market value. Now book value per share is basically picked up from balance sheet. So this talks about the past, whereas market value per share is picked up from the market. So this is future oriented. Okay, so formula wise, let's see. This is some numbers, I'm just skipping them. Yeah. So formula wise, what we have to understand is it's market value to book value ratio. So market value will be in the numerator and book value is going to be in the denominator, and it indicates how many times the market is ready to pay against the book value of a share. Thank you so much. We have come to the end of this mini webinar, and I am sure you would have derived much value from this short and crisp webinar. In my opinion, what you have seen is only the tip of the iceberg. There are several other interconnected topics which you have to learn in order to achieve excellence and mastery. So if you wish to continue this learning journey in a more organized and structured way, I have an amazing opportunity for you. I have published a series of comprehensive courses in financial domain, each costing rupees 2000, but I'm going to give it to you at a special offer price today. Here we go, Finance and Accounting Mastery Bundle. In this bundle, I'm going to give you a series of courses. To start with, we have Financial Management, a complete study. In this course, you will be learning financial management in depth. Topics like basics of financial management, time value of money, financial analysis like ratios, cash flows, fund flows, cost of capital, capital structuring, capital budgeting, NPV, IRR, everything discussed in depth in this course. Then we have course number 2. Advanced Financial Management. It's a comprehensive course and you will learn various advanced concepts like advanced capital budgeting techniques, risk analysis, sensitivity, derivatives, leasing, forex management, portfolio management, dividend decision, mergers, acquisition, several miscellaneous topics, and securitization, security analysis, valuation. Next, we have course number 3. Accounting Basics, a complete study. This course will give you solid foundation in basics of accounting. You will learn basics of accounting, technical terms in accounting, double entry system, journalizing process, final accounts, everything in depth, a comprehensive ever course. Then we have course number 4. Advanced Accounting, a complete study. In this course, various advanced topics in accounting are discussed and covered. Just have a look at the screen for the topics, exhaustive topics that are covered in this course. Then we have course number 5, that is Cost Accounting, a complete study. In this course, you will learn various topics related to cost accounting. You have topics starting from basics of costing till ABC costing. So overall, 5 courses, each course priced 1,999. The overall value is close to 10,000 rupees. It's 500 plus lectures, and what you get is lifetime access to all these pre-recorded courses. You can access them in mobile app and desktop. All this is going to cost you close to 10,000, but today you can enroll for just 2,499. It's not yet over. I'm going to give you something more. You are also going to get access to various bonus resources, basically ebooks. So it is overall value close to 10,000 rupees, 15 ebooks of value close to 1,500. You are going to get lifetime access to all these courses and e-resources.